Hi, everyone. My name's Amanda Hahn,
And I'm Matt McFarland.
and we are with Keystone CPA, and we're here today to talk about K-1s and taxes for passive investors.
Yeah, well, we help investors and syndications throughout the year, especially during tax time. We get a lot of questions around, how to, read, understand K1s. What are some of the things to look out for as an investor, when you're putting your tax information together, when you're investing in a syndication? What are some things to make sure you're setting up correctly, in terms of your K1 investments, all that good stuff. So we want to hope to go a lot over a lot of FAQs today, and hopefully you guys can take away some good nuggets.
Yeah, I think it's good things to know too before investing in passive investments, but definitely after you've invested. So like I said earlier, our company is called Keystone CPA, and we work both with syndicators as well as passive investors. And not only are we CPAs, but we are real estate investors ourselves. So we're really excited to talk to you guys about some FAQs with respect to K1. So put together a sample K1 that you can see on the screen.
So I apologize to John Smith stealing his information.
Of course, this is a fake K1, but quickly wanted to talk about highlight some of these major areas on the K1s that you should be looking for when you receive it from the sponsors you've invested with.
Yeah, so I think the first thing that comes to mind, and we've highlighted a couple of these areas, part two and information about the partner. That's the information about you as the investor, right? So
that's the dark blue area.
Yeah. So going back to think back to when you actually invested in the partnership, right? In this syndication, in our partnership is called ABC LLC because we're very creative. But think back to when you invested in it. How did you invest in it? Did you invest in your personal name? Did you invest in a partnership name or a single member LLC or a trust? That's the important information here because now we're looking at what is the name of the partner, what's the EIN or tax ID number. Does it show as a limited partner? Are you a LLC member? Are you a general partner or a member manager? Those kind of things is what, when you're getting your K1 back from the sponsor, the syndication, you want to take a quick look at this and make sure that, if it does list your name, that's the name of what you invested through, right? That you invested in your personal name, or if it shows an entity, it shows the right entity name, right? Or if it's an LLC as a tax as a partnership or an S corp, or those are kind of things you need to make sure you're looking for.
And if you don't know whether it's being done correctly, then what you can always do is send this K1 to your tax person, your personal tax preparer, and have them take a look at it for you. But yeah, I think like Matt said, one of the most common errors we see is like, let's say you formed your own LLC to invest in this syndication, but the K1 might say your name, so that could be an example of where you want to send this back to the sponsor and say, hey, can you please change this for me? Or a very important one is like if you've invested with your IRA, then this section in that dark blue, that should have your IRA information, not your personal information.
Or another situation we see sometimes is you started the investment in your personal name, and then year 2 or 3, you transferred into some sort of LLC, single member LLC or something, and maybe you forgot to tell the syndicator, or maybe you told them and they forgot to update it, and you get the K1, it still has the old information on. That's where you want to make sure that you tell them so they can have the tax preparer update that information.
Yeah. I think the other main one for those of you who are most of the people that we work with and all of you guys today too are investing in rental real estate, whether it's commercial property, self-storage, multifamily, mobile home parks. Usually the tax loss number you're looking for is on line number 2, which will show your tax rental loss. We're going to go over that number in a little bit on our next slide, but that's one of the main numbers that probably as an investor you want to be taking a look at.
Yeah, and you'll see in our situation here, so down at the bottom left, we didn't highlight it, but just so you can kind of see it, section L there, partner's capital account. So in this situation, John invested $50,000 into this partnership. In the particular tax year, they have a $20,000 loss. John also received a $5,000 distribution. So at the end of the year, his capital account is down to $25,000. Now, that doesn't mean his ownership percentage changed during the year. It doesn't mean, what percentage of income or loss going forward necessarily is changing. It's his rolling investment in that partnership is started at 50. He got 5 back for distributions. He got a share of the losses. So that brings his capital account down to 25,000.
Yeah. And then in the yellow, we've highlighted distributions. That's another one probably to pay attention to. So typically this will represent the amount of distributions that the syndication had given back to you during the year. So maybe a good practice just to kind of match it up to your records and make sure that does match the distribution amount that you received in that specific year. Okay. All right, so let's now go over to, so now that we kind of cover like the big picture of, what is on a K1, let's go over some FAQs. I think probably the most common one we hear is, why do I have such a large tax loss? Typically, people are looking at box 20, right? Where, I invested 50,000, now I got a $20,000 loss on my K1. What does that mean? Is the syndication doing really bad? So let's go over what exactly that loss represents.
Yeah, and to kind of squash the anxiety, right? It doesn't mean that the partnership of syndication is doing very bad. This is very common, obviously, in years 1 to early years and excuse me, rental real estate partnership syndications, because what they're doing is they're probably doing a lot of rehab work, a lot of getting the property up to highest and best use, doing a lot of rehab. They're maximizing depreciation expense, maybe through a cost segregation study. And so what they're trying to do is on paper generate, at least a break even, if not a loss for the investor, so that they're not having to pay taxes at the end of the year on the operation. So very common, a lot of times this is generated again through depreciation, what we call like a paper loss. Doesn't mean that the partnership lost money. It's just there. In the IRS world, you get to take a write-off for a portion of the building amount every year because for normal wear and tear. So that's generally what it represents.
So yeah, so it's a tax loss based on tax strategies and kind of the operations of the business. It does not mean negative cash flow, or doesn't necessarily mean that the business has lost money. But this number represents your share of the losses, right? So the entity using different strategies created a large loss depending on your ownership percentage. Now you're allocated part of that loss. This is the number that goes on your personal tax return. Okay, and then I think our next question is, how do the K1 losses impact me as a real estate investor? So now you've got this K1, there's $20,000 of losses. Do I, what can I use it to offset? The answer to that question is going to differ depending on every investor's unique situation. So if you have other passive income, whether it's from businesses you've invested in or other rental properties or other passive syndications, typically these losses can offset different types of passive income. For those of you who might be real estate professionals on your own, it may be possible for some of these losses to also offset other types of income as well beyond your different types of passive income. But again, the answer to, how does this impact me? It's going to be very different person to person. And that's why it's really important for you to work with your tax advisor to figure out, what's the best way to utilize or preserve these losses. The main benefit is, even if you're not able to use the losses, you do get to carry them forward indefinitely to offset taxes from future passive income. Okay.
So next question, we get a lot about questions about distribution. So, you can see here in our example in yellow, the distributions that this investor received from the partnership during the year was $5,000. Obviously, clearly, you can see this is different than the line 2 amount. That's a question we get a lot is, people like, hey, I got $5,000. I received $5,000 in distributions during the year. Does that mean I'm going to be taxed on my $5,000? No, not necessarily. A lot of times that's not even the case at all. Again, what you have to include in your personal return is generally, in our example here, is based on line 2. So you have a $20,000 loss even though you received $5,000 in cash. And again, that's very common because think back to what we were talking about. That $20,000 loss on line 2 is just based on tax strategies, right? It's based on maximizing depreciations, paper write-offs. Doesn't mean that the entity spent a lot of money and yours is a $20,000 share of the cash that went out from the partnership. So you can see it's very possible that you can have a net loss for tax purposes, but also receiving cash. So in our example, generally speaking, that line 19 for distributions, generally that's as long as you have a positive capital account at the end of the year. We see that in the bottom left here, the 25 grand that I talked about. Generally, your distributions are not taxable to you at all. So generally, you don't have to worry about that.
That's the benefit of investing in real estate, right? Or syndications too. You get a distribution and, got some money back in your pocket, but also at the same time, you might have tax losses that you can benefit from. All right. So what happens when the property is sold? This is a question that we get sometimes too, right? In terms of real estate, because at some point in time, maybe the goal is to sell the underlying asset. And if the investment strategy has worked out well, hopefully you're selling this real estate for a gain, right? Or at least the syndication is selling it for a gain. In the years when the property is sold for a gain, you'll see that gain reflected on your K1. Depending on the hold period, typically it comes through as long-term capital gains. One thing to keep in mind is in most syndications, because earlier on, the sponsors have utilized a strategy of accelerated depreciation, right? What that means is that as a group, you've probably written off more of your cost basis from the real estate. And in other words, then when you later sell the property, the gain is going to be higher because we've already written off part of our cost basis previously through depreciation. Now, what happens to you when the property is sold? Basically, what will happen is on the K1, you'll see a gain amount, your share of the gain. And so it's really, really important, if you know that a property is going to be sold, like earlier during the year prior to being sold, to meet with your personal tax advisor and look for strategies to see if you can offset taxes on some of that capital gains. Earlier we talked about if you had losses, right? What if I had losses previously, I wasn't able to use it? Well, here's your chance. So if I had a bunch of passive losses in the previous years, now it's being sold a couple of years later, I can use those passive losses to offset this gain that I'm now looking at. Other strategies might be investing in other syndications or other rental properties to create more losses. Those losses can also be helped to use to offset the gain on the sale of a syndication asset. So a lot of different strategies, but the key here is the solution to how to offset or minimize your taxes when an asset is sold here is going to be different from person to person. So another reason why you want to keep in touch with your tax person ahead of time.
Another question we get is a lot is, can I file my own tax return if I haven't received my K1 yet? Now, can you do that? Yes, you can. But the better question is, should you do that? And generally, the answer is no. You're going to want to wait till you get your K1, just because it's going to have numbers you have to include on your tax return, obviously. Now, sometimes those numbers might be zero. They might be immaterial to your determination. Having said that, though, as a general practice, it's always best to wait till you get your K1s to file your own tax returns. And that's another reason to be in constant communication with your tax preparer, also the syndication, just to get an idea of when should we expect those K1s? Because just because you may be meeting with your CPA on April 1st doesn't mean the syndication is going to get you the K1s by April 1st. So you have to take that into consideration when you're planning around when you're going to do your taxes and get them done.
Mm-hmm. Yeah. All right. So do I need to file state tax returns? I think a related question we hear a lot too is, why do I get all these state K1s, right? So syndication might invest in not just one property, sometimes multiple properties. And so multiple properties in different states, oftentimes there will be different K1s for the states. Depending on the state law, there are also states where they require a K1 simply because one of the general partners who are actively involved in the business reside or do business in those particular states. So unfortunately for US taxation purposes, every state has its own different state law. So you never know when you're investing in something, whether, which states you might get K1s for. Now, the question though, do you need to file state tax returns for each state where you get K1s in? The answer will also depend on what states those are. As well as what's showing up on the K1s, right? So there are some states that say you have to file just because you got a K1. There are other states who say, well, you only have to file if you have a K1 and it's showing taxable income. So here's another reason that, when you get the K1s, don't just, put it in a folder, but send it to your personal tax person sooner rather than later, so they can help advise you on and plan for which states you might want to file in personally.
And along those lines, think about the life cycle of the investment in the asset, right? So you might get a K1 early on that shows a loss, and your tax preparer determine, well, based on the tax law, it's got a loss. I don't need to file because it doesn't show income. Well, does that state allow you to carry forward that loss if you did file your tax return? If so, that might be beneficial to file, even though you're not going to owe any taxes, because if you can carry forward that loss and offset the expected gain in year 5 when the asset is sold down the road, that's going to help you offset future state taxes for that state in year 5 when the asset is sold. So think about the life cycle of the investment too.
Yeah. And a lot of that comes down to the cost benefit analysis. Like, what is your tax person charging you to do a state tax return? And what is the expected current and future benefit of filing in that state? So, definitely something to keep in mind. But also, I think from the sponsor's perspective too, I know most sponsors, if there are instances in a state where they can file taxes on your behalf, and do withholdings, typically they'll do that because sometimes that helps alleviate the burden for you as an investor. Unfortunately, not all states allow for it, and that's the reason why you have some states where the syndicators will file for you at the entity level, and then other states where you and your personal CPA will make a decision on what to do, right? Awesome. Well, thank you so much for your time with us. We talked a lot about the K1 itself, but we actually came out with a new ebook called How Passive Investments Can Help You Save Taxes. And the reason we wrote that, it's a really brief ebook that you can download on our website using this QR code or go to KeystoneCPA.com. But we wrote this ebook because there's so much misinformation and myth about why there's no tax benefit in investing in passive investments. And our ebook is really designed to shed some light on what are some truly powerful tax saving strategies that can be utilized for people who are investing in passive real estate. So definitely check those out. And thanks for your time with us.
Thanks, everyone.